All right. I don't see the little thingamabob. I'm going to assume
We're good.
we're good. All righty. It didn't have the little okay deal that comes up. Okay. 20 September. This and that. This and that on the TAC. All righty. Well, we're moving right along. We're up to chapter 10 in Hudson. They're short chapters. They read, and I'd like to think they read quickly. Although, if you're not horribly familiar with how, sort of investor stuff goes on, it's got a lot of those little nuances to it, I suppose. Um, Needless to say, I'm integrating some of the other things that I'm working on into it. So I came across an article that just came out today. It's called Head in the Clouds, a Deleuze-Guattarian, it's a neologism, analysis of the environmental impacts of digital memory. Now, if that doesn't throw you off, I don't know what will. But the idea of a digital memory is actually a very interesting one, and I think a humanist approach, and certainly it's integratable with certain types of ecological ideas. So I'm not going to bore you with that, but I will indicate that. Let me just read the abstract, and I think you'll get it. Perhaps not. It's unclear that how it can be fully articulated, and it probably take a whole couple of hours to sort of work through it. But it is Deleuze and Guattari, and they have a theory of assemblage. Some of you may be familiar with the idea of collage, right? Assemblage is not that different and runs into the same kind of principles. And needless to say, it's a modernist idea associated with art. Digital memory in the 21st century is a complex combination of human and non-human elements that interact in various combinations. In an era where environmental devastation is inundating the planet, it's vital to address the digital's role in this degradation. This article explores various facets of the environmental implications of the digital storage of memory objects using Deleuze and Guattari's assemblage theory. I identify the ways in which the digital realm is constructed or territorialized in Deleuze-Guattarian terms. Boy, that just rolls off the tongue. Beyond identifying the most common myths related to digital memory's environmental impact, I expand on the work of information theorists such as Clemens, Floridi, and S by forwarding three ways in which digital memory practices can be de-territorialized. These approaches include, number one, knowledge acquisition; number two, taking responsibility, or as she says, it's response dash ability; and number three, anti-redundancy movements. So essentially, it's well, I don't get too far into this. I argue that it is vital for cloud storage users, especially those who self-identify as environmentally conscious, to align their online memory practices with accurate understandings of the environmental impacts of the digital. So we really, on the one hand, we may not be running out of memory, but it appears that there's something in there that we should probably be thinking about because it has to do with organizing those kinds of things. And to carry this further, assemblage theory comes from Deleuze and Guattari's book, A Thousand Plateaus, Capitalism and Schizophrenia. But it also draws from dynamical systems theory, which I talked about yesterday, which explores the ways material systems self-organized and extend the theory to include social, linguistic, and philosophical systems in order to create assemblage theory. So there's something going on there. It is actually quite it has analytic things. It's just not sort of made up, and it is a kind of systemic approach. Now, on the other hand, it's it has all the other usual arguments. Yes, what I was mentioning yesterday, J. Doyne Farmer, and his book on chaos. And so you can see there's a connection there. And this is just to show that he's interested in dynamical systems as well. It is an article estimating initial conditions for dynamical systems with incomplete information. And these are uh, these ideas are ways in which we can approach larger questions and problems. Farmer was talking about agent-based modeling and a variety of other things which have to do with a more evolutionary approach to large-scale information. So anyway, we'll talk about that at some future point, I suppose. I have to get a copy of J. Doyne Farmer's book as well. Anyway, it's a day after Talk Like a Pirate Day, so I won't trouble you with sounding like one. Yar, R. But yesterday was Talk Like a Pirate Day, just in case you need to be concerned. And even among corporate raiders, Elon Musk is a pirate. So we've been talking for the last couple of days about corporate raiding and a variety of other things, but it was sort of fancifully described as corporate raiding was described as sort of being like a privateer that is being given, which I think was inappropriately applied, or private or piracy, as being sort of how is it the culture of pirates are constructed. And it's sort of interesting to note that libertarians tend to like this idea of piracy, but don't really sort of understand the kind of history of pirate culture, which I find fascinating as well. Needless to say, you could say there are articles that integrate these ideas on pirates, privateers, and corporate innovation. So some of these images are implied in that particular argument. And then I added a thing about, and without going too far into it, the idea that labor is productive and the instruments and the subjects of labor are means of production. So the means of production argument is one that doesn't easily divide. And I would assert to you that discussing financialization, because it is concerned with either the provision of or the delimiting of means of production, is in itself means of production. So you have to sort of think of this much more instrumentally. And I think that's kind of where Hudson is heading. The general argument is, of course, that he's saying that financialization has created a situation where industrial growth or industrialized or manufacturing or whatever, things that are more material aren't being as well supported, economic growth, that is, because of financialization. Financialization is parasitic and, in fact, is killing the host, which is the name of the book. And it does it by denying the productive sector really the opportunity to grow better. So on the one hand, you can pretend that you're getting better knowledge, et cetera, et cetera, et cetera. But in fact, far too many people are just simply, it's actually back to the 19th century. It's not so much that they're idle, but that there are people just simply hoarding, collecting money and stuff. But the fact is that it operates within the context of that some action is going and something is being produced. So it is something that is more appropriately part of the capitalist mode of production. So anyway, finance versus industry. I'll finally get to it. Chapter 10, two opposite sides of the balance sheet. Last year, the corporations in the Russell 3000, it's an indexing thing. It indexes, the major stocks, repurchased $567.6 billion worth of their own shares, a 21% increase over 2012. That brings total buyback since the beginning of 2005 to $4.21 trillion, or nearly 1/5 of the total value of all U.S. stocks today. That's fairly, we could argue that's fairly significant. And this is from an article by Jason Zweig, Will Stock Buybacks Bite Back? And today's financial sector is rating what was expected a century ago to be the social functions of capital, that is, to expand output and employment. So it rating the social functions of capital has an effect on output and employment, and is being stifled in that particular sense. It is, I would argue, a form of expropriation or exploitation. It doesn't have the same kind of a pure structure that a production side exploitation would be, but it still is a kind of exploitative activity. All right, so chapter 10 sort of explains that and more. It doesn't talk about, it points at kind of business school ideology. Economies are slowing in the face of exponentially growing financial claims, that is, bank loans, stocks, and bonds, that enrich the 1% at the expense of the 99%. This polarization leads to unemployment and also to corporate underinvestment by leaving companies too cash-strapped to undertake new capital spending to raise productivity. Business schools teach today's new breed of managers that the proper aim of corporations is not to expand their business, but to make money for shareholders by raising the stock price. Instead of warning against turning the stock market into a predatory financial system that is deindustrializing the economy, that's actually the key point, they have jumped on the bandwagon of debt leveraging and stock buybacks. Financial wealth is the aim, not industrial wealth creation or overall prosperity, right? Rich get richer. The result is that while raiders and activist shareholders have debt leveraged companies from the outside, their internal management has followed the postmodern business school philosophy, viewing wealth creation narrowly in terms of a company's share price. The result is financial engineering that links the remuneration of managers to how much they can increase the stock price, and by rewarding them with stock options. So there's a certain abstraction about this, and some of it is, I'm just breaking for a moment here, intervening, and you can see that how this has gotten driven in a variety of ways. So that whole hedge fund derivative stuff is part of that same thing. It's only focusing on these abstract elements and not the actual economy itself, which was, to privilege it in terms of the Nobel Prize is just stupid and insane. But on the other hand, they gave Bernanke one too. So it's clearly not about economics. This gives managers an incentive to buy up company shares and even to borrow to finance such buybacks instead of to invest in expanding production and markets. Since 1985, U.S. corporations on balance have been net buyers of stock to retire it, not sellers. The effect is to raise debt equity ratios, more debt, less equity. Instead of issuing equity to invest and expand the business and its long-term prospects, companies run into debt to buy their own stock or that of other companies. The result functions like a debt finance takeover from within. Companies become more dependent on banks and bondholders, which press for short-term gains to maximize their own performance measures every 3 months. So you have this, kind of forcing it as a kind of treadmill effect. The traditional corporate aim was to build up the value of plant and equipment, real estate, and other investments over and above a company's debts. According to textbook theory, stock prices reflect prospects for earning profits and paying dividends. Managers are supposed to increase earnings to build up the enterprise's value in the form of tangible means of production. Now, that's all, well and good, but the new aim is to use corporate profits for stock buybacks or to pay higher dividends to shareholders or to pledge to creditors for more loans to create stock price gains. So it just builds on itself. The major factors raising stock prices since 1980 have been the decline in interest rates, easier credit, especially high interest junk bonds for corporate takeovers and management buyouts, and falling taxes on business. Under these conditions, more credit at lower interest rates has a different effect from what economics textbooks describe. Conventional wisdom throughout the 20th century described low interest rates as spurring new investment and employment by lowering the cost of borrowing, and hence supposedly the cost of new investment. That's actually implied in the latest dropping interest rate, dropping the rates at the Fed. But few bank loans or bonds are actually for this purpose. Instead, low interest rates provide easier credit for raiders to attack companies or simply for mergers and acquisitions. On an economy-wide level, asset stripping can be sustained mainly by asset price inflation, that is, increasing prices for real estate stocks and bonds simply by lending more bank credit against them. At falling interest rates and on easier, more reckless credit terms. This debt leveraging ends up increasing the break-even cost of doing business until the corporate sector collapses under the debt burden. And yes, that does happen, and it is happening. Business school endorsement of financialization and debt leveraging, the financial strategy of tying executive pay and bonuses to their company's share price, seemed radical in 1976 when Michael Jensen of the Harvard Business School and William Meckling of the University of Rochester applauded it in an academic paper entitled Theory of the Firm, Managerial Behavior, Agency Costs, and Ownership. Along with a follow-up 1990 Harvard Business Review article by Jensen and Kevin J. Murphy, CEO Incentives. It's not how much you pay, but how. The new theory argued that companies should get their managers to act as agents for stockholders. It's not agents for the company, rather the corporation, but for the stockholders. Jensen and his colleagues had a particular problem in mind when they encouraged corporations to aim at producing capital gains. They were concerned with empire builders whose objective was simply to expand their business and egos by mergers and acquisition. Jensen's point was that expanding without adding to profits just to satisfy the CEO's own glory did not really help stockholders. The hope was that making the stock's price the criterion for performance would curtail this merger mania. Now, that's expecting, the stuff to operate in a kind of a systemic way, and it doesn't quite do that. And it also misidentifies the question of whether price is a measure of value. It can be, certainly, but there's a lot of divergence, and hence the whole problem of theory of value. Stock prices can indeed be increased by practices that have nothing to do with long-term production or higher corporate earnings. They can be bid up temporarily by spending profits on stock buybacks or buying out more as dividends. As matters turned out, CEOs with stock options engaged in activities that Jensen later admitted had backfired by depleting corporate liquidity, leaving less to invest in long-term projects. Now, you see this whole general short-term thing. President Reagan's 1985 Economic Report of the President endorsed a combination of tax subsidy and deregulation for leveraged buyouts on the grounds that whatever generates the highest return is the most efficient use of resources. Contests for corporate control are part of a larger merger and acquisition process that plays an important role in the economy's adjustment to changing market circumstances, the economic advisors concluded. There is no economic basis for regulations that would further restrict the process. This is at the front end of, the neoliberalism. Many prominent business leaders have warned against corporate raiders loading industry down with junk bonds and other debt leveraging, and against paying corporate managers in stock options. Henry Kaufman resigned from the board of directors of Salomon Brothers and later from the firm itself to protest its underwriting of debt for equity swaps. Felix Rohatyn of Lazard Frères also warned of the risks in burdening balance sheets with heavy interest payments. The lawyer Martin Lipton developed the defensive tactic of poison pills to counter the threat of hostile buyouts and wrote a public letter in 1986 to Senator William Proxmire, chairman of the Senate Banking Committee, defending companies against financial raiding. These takeovers move assets into the hands that profit by cutting off research and development and capital improvements, instead divert those revenues to paying the debt incurred to acquire those assets. One can analogize the situation to a farmer who does not rotate his crops, does not periodically let his land lie fallow. This is back to the Middle Ages, does not fertilize his land, and does not protect his land by planting cover and creating windbreaks. In the early years, he will maximize his return from the land. It's very profitable short-term use, but inevitably, it leads to a dust bowl and economic disaster. Day after day, the takeover entrepreneurs are maximizing their returns at the basis of future generations will not benefit from the research and development and capital investments that takeover entrepreneurs are forcing businesses to forego. But in 1993, Wall Street used this agency theory to persuade Congress to give tax deductibility for firms to pay management in the form of stock options. This is Section 162M of the U.S. IRS Code, Internal Revenue Code. Industrial capitalism turns into what Hyman Minsky called money manager capitalism, sacrificing long-term growth by running down the business to generate stock gains. The British financial analyst Andrew Smithers criticized such stockbroker economics in his 2013 book, The Road to Recovery, explaining to Martin Wolf at the Financial Times how the bonus culture aggravates post-industrialization in England and the United States. Smithers said, if you have these bonuses, you'll want to put up the return on equity or earnings per share. And how do you do that? You push up profit margins up more than you would otherwise, and you underinvest. So what we've done is to increase the conflict between the short-term interests of management and the long-term interests of the company. Now, this also has to do with mobility, intra-industry mobility among management, moving around from job to job, et cetera, in order to garner, sort of deals, better salaries, et cetera. Bleeding companies and the economy at large. The economy at large suffers from these tactics as well as companies. Eve Smith points out that the financial managers typically cut back paying suppliers, honoring terms of warranties, complying with environmental product and workplace safety laws, paying creditors, that is the bondholders, banks, owners of rental property, paying taxes, and for public companies, fulfilling their obligations under state and federal security laws. And well, the example in the public sector sort of is, how Trump gets along by not paying anybody, right? He has these events and stiffs the local communities, and of course manages to not return to some of these places. In fact, one of the places he actually did return to, he still owed money to, and I don't think they still have gotten paid back, which was even weirder. One sees the self-defeating effects in nearly every sector. Despite being warned that badly designed ignition keys might result in sudden engine shutdowns causing accidents and deaths, General Motors chose not to spend a few cents more per key. Retailers and credit card companies choose to save $0.25 per card by not putting in the encryption protection that Europeans do. That's the question also of the difference between a regular magnetic strip card and a so-called smart card. This facilitated the massive computerized stealing from Target over the 2013 Christmas shopping season that led customers to avoid Target stores because they feared identity theft. The effect of financial interlopers buying a company and making it appear more profitable in the short run by bleeding its balance sheet, that is, hoping to find a buyer who will believe that the company has been streamlined, lean and mean, and not depleted. It's like a landlord stinting on maintenance and repairs, deferred maintenance, paying bills more slowly, and letting the property deteriorate by laying off doormen and other niceties. The property is left debt-ridden with a stagnating rent roll, unable to cover the mortgage. If we view industry as part of the economic and social environment, today's breed of corporate raiders and shareholder activists are strip mining companies, causing debt pollution, clear-cutting industry, and leading to economic drought. Such short-termism is much like a debt-strapped family having to rely on a junk food diet in order to make ends meet, leading to long-term medical costs and shorter lifespans. Living in the short run does not help make economies lower cost and more productive. The aim is simply to report bigger profits so that managers and stockholder activists can exercise their stock options at a higher price. Also bonuses. Michael Jensen, the academic catalyst for paying managers in stock options, expressed his second thoughts in a 2005 interview. They look for legal loopholes in the accounting. When those don't work, even basically honest people move around the corner to outright fraud. If they hold a lot of stock or options themselves, it's like pouring gasoline on a fire. They fudge the numbers and hope that they can sell the stock or exercise the options before anything hits the fan. By this time, the policy of attacking one company after another and loading each one down with debt had won Wall Street's applause, echoed by the mainstream media. A 2006 Financial Times article noted, with pressure on institutional investors to deliver short-term gains, corporate hellraisers once vilified as vultures and speculators have become champions of better governance. You can see how the concept of better governance can overlap into effective altruism at some moment. Short-termism accelerates as new managers arrive, seeking to win bonuses by slashing expenses even further, running down inventory even more, delaying even longer in paying suppliers, and not replacing retirees, but working the remaining labor force more intensely, shortchanging contributions to the corporate pension fund, and cutting back on employer contributions to health care. Projects with long lead times, headed by research and development, are the first to be cut back. Focusing on the financial bottom line turns corporate management into a race to the bottom without acknowledging how much long-term growth is sacrificed by driving companies to increase stock prices by means of share buybacks, debt leveraging, and higher dividend payouts instead of capital formation. Money manager capitalism replaces industrial capitalism. Next section. The easiest way to increase earnings is to do what Professor Jensen noted, fudge the numbers. Profits can be whatever the chief financial officer, CFO, tells the accountant to report, aiming at targets set by brokerage houses and money managers. It is difficult even for well-managed companies to resist this focus on financial short-termism, which Hyman Minsky called money manager capitalism. Instead of prizing growth as traditional long-term investors did, companies find themselves obliged to defend against raiders and activist shareholders. Cash-rich, low-debt companies taking self-imposed poison pills, running into debt to buy their own stock or that of other companies so as to leave less profit for prospective raiders to borrow against to take them over. Martin Lipton, credited with refining the poison pill to defend companies against such debt finance takeovers, explained why giving activist shareholders the power to raid is dangerous. Excessive stockholder power is precisely what caused the short-term fixation that led to the current financial crisis. As stockholder power increased over the last 20 years, our stock markets have become increasingly institutionalized. The real investors are mostly professional money managers who are focused on the short term. It is these shareholders who push companies to generate returns at levels that were not sustainable. They also made sure high returns were tied to management compensation. The pressure to produce unrealistic profit fueled increased risk-taking. Despite criticism of these trends a generation ago, corporate raiders gained enough political power to block regulation and tax penalties for their debt leveraging. It took until March 2013, 30 years after the trend gained momentum, for the Federal Reserve and the Office of the Comptroller of the Currency, the OCC, to announce guidelines for leveraged buyouts, advising banks to avoid financing takeover deals that would put debt on a company of more than 6 times its earnings before interest, tax, and depreciation or amortization, or EBITDA. EBITDA, TDA. Their suggestion did not prove effective. So far in 2014, 30% of U.S. leveraged buyouts have been financed at a debt to EBITDA, EBITDA ratio of more than 6 times. The most recent peak was in 2007, when the percentage reached 52%. The financial distortion of industrial capitalism. Even the public sector has adopted financial management criteria to squeeze out a positive cash flow. Governments are reducing their budget deficits by cutting back on maintenance and repair of bridges, roads, and other infrastructures, and selling off public real estate and other assets. The effect is to inject less purchasing power and employment to support economic recovery. In academia, this is the story of my life. University have replaced tenured professors with part-time adjuncts that treat each department as a profit center, cutting back classes and programs that do not show a financial return. An internal contradiction affecting this financialization strategy is that engineering capital gains by more debt at falling interest rates lowers current returns on pension funds assets. So there's an effect on pension funds. This requires companies, states, and localities to set aside more revenue if they're not to default on their retirement promises. Pension funds try to avoid this squeeze by engaging in risky speculation organized by Wall Street's investment banks. Many funds have become desperate to earn the 8.5% annual return widely assumed is needed to pay retirees without raising what companies and public bodies need to set aside. Reminding you of the post office scandal attacking the pension fund, or requiring the pension fund to be fully supported. As interest rates and yields fell below this level, many financial managers sought higher returns by backing raiders and financing leveraged buyouts. But by supporting financialization, pension funds contributed to a dynamic that undercut the economy's markets for goods and services, sales, profits, and employment. So this has a snowballing effect. The hope was that financial engineering would create enough capital gains to pay the retirement incomes promised to pensioners without expanding the industrial base. The dream was to live by finance alone, not by bread and any other kinds of basic needs. The financial sector promised to inaugurate a post-industrial economy in which bank customers could make money from borrowed credit created on computer keyboards without a need for industrial capital formation or employment. What actually happened was that financial engineering painted the economy into a corner by increasing corporate debt without parallel growth in underlying assets and earnings, creating more credit, other people's debt, that is, and lowering interest rates to bid up real estate, bond, and stock prices, leaves the economy more debt-ridden and fragile by increasing the economy's carrying charges while leaving less available to invest and hire labor. So you get this kind of weird squeezing going on. And you can see that actually in the data. Communities suffer when raiders or other financial managers make short-term gains by downsizing the workforce. Jobs are lost, and employees who formerly paid taxes end up collecting unemployment insurance, paying out earnings in the form of tax-deductible interest to bondholders instead of after-tax dividends. Also widens public budget deficits, creating political pressure to raise taxes on labor and consumers, before raising property taxes, for example. It doesn't have to be this way. As Chapter 7 has shown, banking was on its way to becoming a public utility in the years leading up to World War I. If this trend had continued, much of the world might have credit cards, deposit banking services, and loans provided at cost or at subsidized rates instead of today's fees and penalties. And this is like a big deal. Business credit funded industrial engineering more than financial engineering, and public banking would be less likely to extend credit for the asset stripping and asset price inflation that characterizes today's financial system. Most futurists a century ago believed that public regulation was needed to keep predatory finance and rent seeking in check. But bankers and financiers successfully instituted a deregulatory economic philosophy and have seized control of governments to use its money-creating power to subsidize high finance while leaving creditors free to stifle the economy's real growth with debt deflation. Today's financial interests denounce public regulation and rentier taxes as socialism, but socialism was not initially a term of invective for classical theorists. John Stuart Mill was called a Ricardian socialist because classical economists were moving toward reforms that they themselves characterized as social, and hence as socialist. Most reformers referred to themselves as socialists of one kind or another, from Christian socialists to Marxist socialists and reformers across the political spectrum. The question was what kind of socialism free market capitalism would evolve into. The reform era leading up to World War I expected the natural evolution of industrial capitalism to steer savings, wealth, credit, and new money creation productively. Like other natural monopolies or special privileges, finance was to become a public utility, situated in the public domain, or at least alongside a public banking option. Instead, the past century's expansion of predatory credit has been reinforced by detaxing interest, land rent, financial speculation, debt leveraging, and capital asset price gains. At issue is what the economy does with a surplus of productive capacity and savings over and above its break-even needs. Industrial profits are being diverted away from new capital investment to support stock market prices and enrich the 1%. Instead of using financialized wealth to build up the economy, managers are diverting corporate income and bank lending mainly to increase the market price of their assets and to build up their financial claims on the economy in the form of debts owed to banks and bondholders. Central bank support for financial bubbles. Managers pay themselves enormous sums ostensibly for inflating the price of their stock. But the overall surging level reflects the Federal Reserve's wave of money creation more than actions by most companies. The financial sector is riding this wave of quantitative easing and tax cuts, thanks largely to the control of the Treasury and Federal Reserve and capture of the regulatory agencies originally meant to steer credit along more productive lines. The key to making money from money is for creditors to lend it at interest. Today's families, most simply seek to break even each month while carrying their home mortgage, student loan, and an auto loan if they need to drive to work. Merely avoiding further credit card debt is a victory in coping with their immediate economic demands. More affluent borrowers hope to realize speculative gains from real estate, and the economy's wealthiest layer uses hedge funds to raid corporations or more recently to buy real estate at distressed prices. The common hope is to ride the wave of asset price inflation for real estate stocks or bonds bought on credit. A financial bubble is the kind of inflation that Wall Street loves, in contrast to wage and commodity price inflation. A bubble raises the price of financial assets and property relative to living labor and the power of inheritance over non-heirs. This is the Piketty issue. Asset price inflation is the primary dynamic explaining today's polarization of wealth and income. Yet most newscasts applaud daily rises in the stock averages as if the wealth of the 1%, who own the great bulk of stocks and other financial assets, is a proxy for how well the economy is doing. What actually occurs is that finance and corporate buyouts on credit factors interest payments and fees into the prices that companies must charge for their products. Paying these financial charges leaves less available to invest or hire more labor. Likewise, for the overall economy, the effect of a debt-leveraged real estate bubble and asset price inflation is that interest payments and fees to bankers and bondholders leave less available to spend on goods and services. The financial overhead rises, squeezing the real economy and slowing new investment and hiring. Wealth created by rising asset prices fueled by interest-bearing debt thus sucks income out of labor and industry. The bubble economy versus classical industrial growth. The stock market is not the largest part of the economy whose prices are inflated by bank credit. As the largest or the biggest asset category, real estate is by far the largest market for debt. The Federal Reserve's quarterly flow of funds statistics show that by 2007 to 8, about 80% of new bank loans were real estate mortgages. Most such loans are to buy property already in place, just as most stock market transactions are for shares long since issued. The effect is twofold. It inflates asset prices ranging from real estate to entire companies and yields banks interest that imposes a carrying charge on buyers. That is what makes bubble economies high cost. Housing prices are inflated, requiring mortgage debtors to pay more. Companies borrow to buy other companies, increasing the volume of corporate debt simply to finance ownership changes. And education is financialized, enabling students to afford higher tuition costs, which have already been marked up, by committing to pay monthly debt service out of what they earn after they graduate. So, debt service goes on until you die. The resulting financial overhead consists of claims on the economy's actual means of production. Yet most people think of these bonds, bank loans, and stocks and creditor claims as wealth, not its antithesis on the debit side of the balance sheet. This inside-out doublethink is a precondition of the bubble economy to be applauded by the mass media, keeping its corrosive momentum and expanding all those touts on CNBC and Fox Business, etc. From the corporate sphere and real estate to personal budgets, the distinguishing feature of the past half century has been the rise in debt equity and debt income ratios. Just as debt leveraging has hiked corporate break-even costs of doing business, so the cost of living has been increased as homes and office buildings have been bid up on mortgage credit. Creating wealth in a debt-financed way makes economies' high costs exacerbated by the tax shift onto labor and consumers instead of capital gains and free lunch rent. These financial and fiscal policies have enabled financial managers to siphon off the industrial profits that were expected to fund capital formation to increase productivity and living standards. The financial disconnect from the industrial economy. Most capital investment in the US and other economies normally is self-financed out of retained corporate earnings, not by borrowing from banks or bondholders. During the 35-year upswing spanning the return to peace after World War II until the 1980s, remember we talked about that golden period from the DeLong book. Profits and overall net investment in the U.S. tracked each other closely, with about 9% of gross domestic product, noted a recent Financial Times report. But this correlation between capital investment and corporate profits began to break down in the Reagan-Thatcher era. By 2012, the National Income and Product Accounts, that is NEPA, were reporting that pre-tax corporate profits had risen to a record 12% plus of GDP, while net investment is barely 4% of output. Although corporate profits have soared in recent years, they're not lending to new tangible investment output or employment. The explanation for this disconnect is financialization. So 40% of profits are now registered by the banking and financial sector, not industry. In the manufacturing sector, managers increase reported profits by cutting back basic spending, letting their physical investment run down, and replacing long-term skilled employees with less highly paid new recruits, while using the remaining corporate profits increasingly for share buybacks and higher dividend payouts. These practices have decoupled financial management from investment in new means of production. The idea that economies can get rich mainly from the debit side of the national balance sheet reflects the degree to which creditor interests have taken over the economy's brain. Finance capitalism is based on exponentially growing debts owed to creditors. Industrial capitalism is based on expanding tangible capital investment, employment, and markets. Not the same thing. While personal and business income is diverted from production and consumption to pay debt service or to bid up asset prices, the real economy cannot expand. And when the debt bubble overhead grows to a point where the economy cannot pay anymore, the financial sector demands payment for the debts run up, imposing austerity, which is probably the worst result of all of this. Chapter 11 describes this bubble sequence from asset price inflation to debt deflation. So I included a little thing on dynamic systems modeling, and so it involves constraints, spontaneous behavior, task constraints, and environmental constraints. And this is like most of these kind of diagrams. The idea is that it is about circulation. It does, it uses lots of jargon and stuff, but the big point about this is circulation, is Department 2, as it were. And so what are the intellectual goals of dynamic systems theory? How can you create something from nothing? What are the origins of novel forms of behavior? The promise of dynamic systems theory is that you can innovate your way out of trouble. May not be able to do that, but it frames developmental questions in terms of when systems are stable, when they change, and what makes them change. And that raises certain environmental or ecological questions at various levels. Views traditionally separated domains as subsumed into the same dynamic process. This is a much more totalizing, as it were, kind of process. It's because it is a systems form of analysis that goes all the way back to systems, Herbert Simon and a bunch of other folks, post-war planning. Captures the richness and complexity of real life human behavior. And so as a modeling thing, it's useful at one level because it can predict, a variety of things. Like I was trying to explain with the lecture I listened to yesterday, I guess, by Farmer about how they were able to predict provide with a certain degree of prediction how certain industries would experience certain types of drops and then recoveries in because of COVID, and because you had this sort of nice little model there, because you had a global shutdown or at least a very large scale shutdown. You could actually measure 300 companies and sort of say, well, okay, this part of the economy is going to go up, down, but it's not going to go all the way down. And so you can actually plan for some of these things. All right. So I finished my yammering. Let's see if there are questions or comments or brickbats or whatever. Yar. Yes, it was blockchain, biggest consumer environment, very inefficient in digital memory. Yes. Yep. Most of the work thrown away. Yeah, it's designed to sort of it's not ahistorical but anti-historical in a certain way because of the way it the way it ensures its security, but yet in doing that it gobbles up a shit ton of energy. Let's see, no other questions. No other comments. Tonight, at 10 o'clock, rather than open dialogue, we are at the end of The Prisoner. And sadly to say, as most will observe, it's not like there's a kind of satisfying closure or conclusion to the series. On the other hand, there are just more questions, but in an interesting way, because I think you saw some of that in last week's the 16th episode 16, which is the front end of today's episode or tonight's episode. So that's happening, and we'll talk about that more when we get to after hours. I just thought I'd mention that ahead of time. We are going to have Twilight Zone. The episode is called Nightfall and it has Gladys Cooper in it, which is actually quite interesting. Okay. It's you can I've given up control, so Joe, if you're there, you can shut the